A lot of people think they understand infinite banking until it's time to get a loan from their insurance policy. The thing is if you can't explain it, then you don't quite understand it. Because if you can't say where the loan is coming from, who you owe, and what happens if that loan is repaid, then you may not quite understand the concept. So in today's video, what we're going to do is we're going to discuss the mechanics of policy loans. My name is Darius.
And I'm Carmen. Now, the one question you should be asking yourself is, where does the loan money come from? Is it coming from you? Is it coming from the insurance company? Where is it coming from? And the answer, family, is the money when you request a loan actually comes from the life insurance company. It does not come from your policy. Why does it not come from your policy? Is because your policy is going to be used as collateral. Perfect example, I'm just using easy numbers here, right? Let's say I request a loan for $10,000. I'm gonna go to Darius, the insurance company, and I'm gonna say, hey, can I get a loan for $10,000? He's gonna look over at my policy and say, is it valuable enough to hold this as collateral? And if it is, he'll say, what?
Yes.
Yes, what?
You can't use this loan, this policy as collateral.
I'll give you my money. Right? So now I'm going to use his money. He's put my policy up as collateral. And the beautiful part about this is that my money inside my whole life insurance policy is going to continue to grow. The cash value is going to continue to grow. The death benefit's going to continue to grow. I'm just using the simple tool of leverage. Right? I'm not liquidating my assets.
You're not getting a withdrawal from your cash value.
Hence the liquidation. I'm just using leverage. I'm using OPM, other people's money, so that I can continue to stay liquid.
Yes. So you're not getting a withdrawal from your cash value when you're getting a loan. You're not lending yourself money when you get a loan. You are borrowing from the insurance company's general account. Remember that. You are borrowing from the insurance company's general account. So the policy, to Carmen's point, is used as collateral.
Now let's get a little deeper into the mechanics as far as requesting a loan from the life insurance company, right? If you are dealing with a specific company that is direct recognition or non-direct recognition, that may determine how much money you can actually access. Here's what I mean. Direct recognition companies mean that they directly recognize that you have an outstanding loan. What does that mean for you? Is that if a dividend is going to be paid out that year, they're going to hold on to the dividend and they're not going to give it to you, right? Until you pay the money back.
Right, or at least they're going to hold on to a large portion of it.
Exactly. Now, a non-direct recognition, you see where I'm going here, does not directly recognize that you have an outstanding loan, meaning whatever cash value is available to you, you can have access to. So you have to understand these mechanics when you're shopping for life insurance companies. And we're not saying that either one is bad. We're, again, just saying awareness. Understand if you're working with a non-direct recognition company, what are the stipulations versus what does it mean to work with a direct recognition company.
Right, and this is all depending on the carrier that's being used for your whole life insurance policy. So again, remember that cash value is not being withdrawal. At this point, we're still talking about loans, and we're just talking a little bit about the mechanics of it. And these are the things that you should understand as you get your loan, whether or not it's direct or indirect, non-direct recognition, because that's going to determine the treatment of how your system continues to grow as you continue to use it.
Now, the other thing to consider, family, again, growth is not guaranteed. There's two different kind of ways in which you can look at this. Of course, the life insurance company has to provide a specific guarantee to you, but once we start adding on dividends, it's important to note that the dividend can significantly compound the growth that happens inside a life insurance policy, but a dividend is not guaranteed. So again, as you're looking at the illustrations that are coming your way, definitely make sure you understand the difference between the guaranteed values that are guaranteed to you by the contract versus the ones that are not guaranteed, and how does that work in the whole grand scheme of things.
Right, just imagine like you have access to these funds, which gives you liquidity, but you also have to work within the parameters by the insurance company. So you have control systems in place to keep you in a place to where your capital that you're accumulating is for death benefit. So this whole system or the insurance policy is to maintain the fact that you can get death benefit over to your beneficiaries. This isn't a way for you to make money. It's not someplace where you can go and get manufactured returns. It's a place where you preserve wealth so that you can pass it on to your beneficiaries.
Now, one question that usually comes up during this time is people say, hey, Carmen and Darius, how can the life insurance company afford to pay me any more money? And just the high level understanding of this is that the life insurance company is a business, right? They have to take what you are giving them in policy premiums, your cost for life insurance, and they have to invest that money so that they can get a positive return, so they can keep paying out those death benefit claims as, unfortunately, we lose loved ones.
Right.
So those are things that we need to keep in consideration. The life insurance companies are a business. We are all paying premiums, right? So of course they're profiting in those ways. And then the point is what sound investments do they have to make to ensure that they can guarantee you a return?
Right. Now, here's another thing for you is who charges the interest? Well, the interest is charged by the person who gave you the money in the first place, which is going to be the insurance carrier. So insurance interest rates are, I would say, anywhere from about 5 to 8%, at least the companies that we work with.
At the time of making this video.
At the time of making this video. So if you come and watch this 5 years from now, it may change. But just to let you know, the interest rates are created by the insurance carriers. And the next thing to understand about those interest rates is that you are charged simple interest annually. However,
on the policy loans.
On the policy loans. So for example, let's say you have a 5% interest rate and you have to pay $500, but you decide to pay that loan back early. The interest is accrued daily up to that amount. So if you pay it back early, what you'll get is you won't pay the full 5%. Let's say you did it in 6 months, you only paid 2.5%. Just those mechanics. Even if you pay it, you have an outstanding loan and you pay it within 2 weeks, you'll pay whatever interest that has accrued up to that point on that simple interest 5% up to that year.
And the thing to know that if you don't pay the interest, it's going to be added to the loan balance, right? So of course the life insurance company is going to make sure that they get their payment, and how your charge, essentially the interest, is always going to be in your anniversary. So as Darius was saying, if you get a loan in January, come next January, not only do you have to pay the principal, but you also have to pay the interest.
Right. And your interest is on your contract.
Yeah.
So if you have any questions about if you have a insurance policy and you want to know what your interest is, look at your contract, because it's on your contract.
And here's one thing that I want to address, because people, there's so many things I want to address, is that people tend to look at the interest as like a penalty.
Yeah.
Right. And I can understand where we're coming from with that because of traditional banking systems and us having to owe interest on all these things. But the simple fact of the matter is it's just good business, right? If you borrow money from me, I'm going to charge you some interest for holding my money for a certain amount of time. And also, this is an amazing way for people who understand how to flip money for you to keep your money liquid and be able to use somebody else's. So yeah, we get the question all the time, why would I borrow from the life insurance company when I can just use my savings account? When you just use your savings account, all of that money is gone. Now you're no longer liquid. So I would rather keep my money in the savings account, borrow from somebody else, pay them back when it makes sense for me and in the amount that it makes sense for me to include the interest, so that I can stay liquid.
Yeah, and I think a part of it is just a misunderstanding of where the money comes from.
True.
Because they think if I'm borrowing money from myself, which isn't correct, then why am I paying interest on money that I'm borrowing from myself? When that just isn't true. You're borrowing money from the insurance company.
Yeah.
You're just using your policy as collateral to get that loan.
Now this one gets juicy. I know we've said it in videos, and we want to make sure that we're clear and that you hear us when we say like there's no repayment schedule. What we mean by that is not that you don't have to pay anybody back. You always need to pay the money back. What we mean is that unlike a credit card or unlike a traditional loan, like you have a car loan, they're not going to say March 15th you have to pay the bill. They're not going to say April 15th, May 15th, right? There isn't a schedule that they typically send to you and say these are when your payments are due.
Right, but you also have to remember that you have to be responsible. You have to be responsible when it comes to your finances and the systems that you create, because when you borrow money, you have to have a plan in place for it to come back. Now, it may not be like a monthly payment schedule. It may not be a annual payment schedule depending on the type of investment, but you have to have a plan in which the money is being paid back, because it's costing you to have that loan outstanding.
So let's break this all the way down, right? So that we don't lose anybody. Going back to this $10,000 loan that I was talking about earlier that I was borrowing from Darius, before I even knock on his door, right, I should know how I'm going to pay this $10,000 back, plus interest.
Right.
Right?
What you're doing with the $10,000. Am I making an investment that's going to pay me 10% interest?
Back.
Know that before you knock on the insurance company's door.
Yeah, exactly. So where we feel people fall into trouble is they get the loan for $10,000. There's no discussion or understanding of how they're going to even pay it back. They just request the loan, and then year after year, they still have the outstanding loan, and then they still have the accrued interest that's building. And then you look up years later and you're like, how am I going to pay for this thing?
Right.
Right. So that's what we want to make sure we understand when we say there's no repayment schedule. We mean there's no like due date.
Right. So here's an example.
Specific due date.
Here's an example.
But you have to pay it back.
You borrow the money to buy a house for your child. Now your child doesn't have a mortgage, so to speak, but it's still their responsibility to make the payments on that house. Like, yeah, or either you borrow money to get a house for your kid and you're making the payments back. But what you still have to do is make sure those payments are coming back. It's not that you buy a house and you're just going to let the money appreciate and then 20 years down the road, or the kid buys another house and they send you a check or not send you a check. There has to be a plan in place. So ideally what would happen is if you borrow money and buy a house for your child outright, then what you want to do is create some type of system so that they can make payments back to you, interest only payments back to you into your financial company, so that they can get the write-off of having 100% interest on their mortgage, and you can make those payments back to your loan. So you see the system or the idea here when it comes to borrowing money from the insurance company. You have to have a plan in place, or ideally you should have a plan in place so that you can make sure that money goes back, because they're charging you interest, even if it's simple interest at a single digit amount. And
that's where I feel like the term "be my own bank" comes into play, is because you're creating the freedom and flexibility to be able to determine your repayment schedule, what you're investing in, how you're investing in, and what this whole thing looks like. Yeah. Just because we say become my own bank doesn't mean that like all of a sudden you're creating a brick and mortar and now, I think there's just a lot of misunderstandings around the terms and what's actually happening. Right. What we want you all to understand is we're just talking about control. Right? When I get a loan from the life insurance company, now I have control of when I'm going to make my payments, how I'm going to pay my interest, and how whatever investment that I invested in, if I take the $10,000, hopefully I'm making more than the 5 to 8% that it's costing me. And what am I doing with that money to pay it back and grow? Right. So here's the thing. What happens if you do nothing when you get a loan from your life insurance company is the interest is going to compound on you. Year after year, it's going to continue to grow. You're going to have an outstanding loan balance every single year until you pay it off. And guess what? If you happen to pass away, family, let's say, again, simple numbers, my death benefit is $1 million and I have a loan outstanding for $50,000. Now what the life insurance company is going to do is they're going to subtract $50,000 from the million if I were to pass away and give Darius a check of $950,000 because I had an outstanding loan.
But if you didn't pay any interest on the time that you had that money outstanding, that interest is going to be added to that loan. Yeah, so that's how it compounds. If you don't do anything, they're going to charge you interest on top of the outstanding amount. So that interest becomes outstanding if you don't pay it. They're still not calling you, asking you to send a check. Yeah. But that money is still compounding.
As they should, right? Because you owed the money in the first place. And then this is where people sometimes get confused about, well, the cash value, why shouldn't I be paid the cash value and the death benefit if something happens? And the point is your cash value is your death benefit, family. Yes. That's how it works. The only reason why you can get access to any money in the first place is because the life insurance company is essentially siphoning portions of your death benefit to you while you're living.
Right. And the only way you can't get access to your death benefit and it'd be called a death benefit, because you have to pass away in order for it to be considered a death benefit. Yeah. So your cash value is a prepayment of death benefit in the form of a loan if you were to pass away prior to paying that loan back.
Exactly. Now let's talk about taxes, because I think this is the next topic that people sometimes get confused with. And that the simple fact is when you get a loan from the bank, right, that's not taxable income.
No.
Same thing when you get a loan from the life insurance company. That's not taxable income. You're paying it back. You're paying it back plus interest. Right. Okay, so loans are all of a sudden aren't considered a distribution. A loan is a loan is a loan. It's that simple.
Yeah, they're contractual advances. Just think of it like that. It's a contract that you were able to get. You sign on the dotted line, you say, send it to this account, they send you the money. They use your policy as collateral. It's that easy. It's just a simple contractual event. Now, here's where it can be taxable. So when we talk about policy loans or policy premiums, you're paying into a premium and over time your cash value accumulates. Now that gets to a point when you have a policy for an extended period of time. Everybody's different. We generally try to keep our policies between 10 to 15 years before you get to a point to where your cash value is just as much as your premium. So all the money that you put into this policy, you have the same amount of cash value available that you can borrow. Now, and that point moving forward, let's say you were to surrender your policy and you've borrowed more money than you put into it. That becomes taxable because you've taken out more money than you actually put into this whole life insurance policy. That's a taxable event. Let's say you have an outstanding loan and you stop paying for your policy and that policy lapse. And you have an outstanding loan for more than what you put in the premium. That's another example of a taxable event because you have in your possession more money from this whole life insurance policy than you put in.
And what lapse means, as Darius was bringing
You
that up.
stop paying your policy premium.
Yeah, well, you lose your policy,
Yeah.
right? You stop paying it and that means you lose your policy.
You stop paying your policy and there's no cash value to maintain the premium.
Yeah, exactly.
Long story short, loans don't trigger taxable events. People do.
That's a good one. That needs to be a t-shirt. And the thing that we need to stress first and foremost is that infinite banking depends on the mechanics that we've been talking about. Infinite banking is not a life insurance policy, okay? We get people that come to us all the time and say, Darius and Carmen, I want an infinite banking policy. No, what you want is a whole life insurance policy. That's it. Infinite banking is simply the process from the point of you getting a loan from the life insurance company and how you go about paying it back. Infinite banking is that process. You're using the product, which is a whole life insurance policy, to complete the infinite banking concept, if you will.
Right, so think of it this way, and you have to do it in this order. Is first you need to have cash flow, you need to have stable income so that you can buy yourself a whole life insurance policy.
To protect your income.
To protect your income. Now that you protected your income, now you leverage that whole life insurance policy to buy more assets. That's the steps. Step 1, stability. Step 2, income protection. Step 3 is leverage. And then step 4, you need to accumulate assets.
Exactly. Because what we find people go into this is they don't have the stability, meaning the cash flow. Then they try to buy a whole life insurance policy that they can't afford. And then they go get a loan that they can't afford because they don't know how they're going to pay it back. You see how this goes? And then all of a sudden implodes and people go, this infinite banking thing didn't work. Well, yeah. Because it starts with the foundation. You have to have the cash flow because the cash flow is also going to determine how you make your payments back, right? Once you have this life insurance policy, because you shouldn't be getting any loans if you don't have the cash flow to pay it back.
Right.
That's simple.
So it seems like a good idea is to be a good manager.
Yeah.
This is all about talking about being a good manager because one policy loan isn't a problem. It's when you're 10 years into it and you have multiple loans outstanding for different assets that you're bringing income in. If you weren't able to manage your money before you even got the policy with having cash flow, then it's going to be more difficult for you as you start to add more loans and policies to the system.
Yeah. So what is this process? Like, let's throw infinite banking out of the window, right? Because I feel like there's some misconceptions. What you are actually doing, family, is you are just doing collateralized borrowing. People do that without life insurance policies.
Right.
Right? You can completely accomplish this without having a whole life insurance policy. The key factor in this and the reason why we do this is because we use whole life insurance to protect our income.
And it's predictable.
Right?
There's no risk associated with it. As long as you pay your premium, that policy is going to be there. That's the reason why it's foundational that everybody get life insurance so that they can be able to move on to the more complicated things.
Yeah.
And take on more risks. They have a solid foundation when you do everything after you protect your income.
And additionally to this, there's contractual guarantees, right? So there's a little bit of a safety net there.
Yeah.
So going back to the protecting your income, the contractual guarantees, the fact that we're doing collateralized borrowing, we're not doing anything different or new that hasn't already been done for decades, for centuries. right? Everybody always has some, you should always have some sort of collateral before you go into some sort of contract where somebody has to pay money back.
Right. The question isn't, do whole life loans work? The question is, how do these loans work inside of a long-term system?
Right, so before you get all the fancy questions about infinite banking and what this policy is this and what da 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 da, right? Just off top, do you have the cash flow to afford a financial product such as a whole life insurance policy?
Right.
And then from there, what am I getting loans for?
Right.
Right, responsibly. I should be getting loans to create cash flow, or I should be getting loans to pay down this high interest debt that I have so that I can pay that money back because I'm already being charged 28, 30%. So I'm gonna put that back, right? What does that all look like for you? And that's how you determine if this makes sense for you.
Right, because we have access to a ton of tools, but tools don't create freedom. It's understanding that creates freedom. Mm-hmm. So you have to understand before you can get the tools and actually use the tools to the most efficient way possible.
Now, we hope this information was helpful, and if you want Wealth Nation to support you with your next whole life insurance policy, click on the link below. We would love to serve you.
And check out our next video where we talk about when you can get your first policy loan.
And remember to own your own lifestyle.
Or someone else will.